Hi class, this is Mr. Tan here with Shavita Hair Game. Superb. We're still on management accounts and we're on P3. Now, with P3, we are specifically focusing on an example. So we've looked at marginal costing and absorption costing and where it fits in. We've looked at the requirements and we're saying to ourselves, okay, let's do a practical example to actually see how this applies.
Absolutely.
And Shavita, over to you.
Thank you. Thank you for having me. And we'll be looking at P3 question, because when you look at the assignment, you have to attempt a practical question where you have to solve a practical problem and coming to the conclusion saying that should you go ahead with this project or not. If you look at this illustration, which is illustration number 3, and it says if there is closing inventory in place, how we going to produce an income statement using marginal costing and income statement using absorption costing, how the profit's going to be different, and if there is a difference in the profit, what is the reason behind that difference. So looking at the question, we said the example we used in the last class, we said that we're looking into the same question, but the only difference is that there is a closing inventory of 2,000 units. It means we haven't sold everything we have produced. So we have produced 10,000,
Yes.
but we are just selling 8,000, and
Yes.
the 2,000 we will be taking it over to the next year.
Yes.
And that is where the closing stock comes in place. And it says that because we are looking at only 8,000 units to be sold,
Yes.
we have to divide the selling overheads, the variable selling overheads,
Yes.
between these 8,000 sold and the 2,000 unsold.
Yes.
Because they are variable, it
Yes.
means they varies with the sale.
Yes.
So if you're not selling something, you shouldn't be taking that cost into consideration. So for those 2,000 units we didn't sell, we have to take that cost out from the total variable selling overheads. So if the total variable selling overheads was $187,500, that's for 10,000, we have to calculate it for 8,000, and clearly it says that for 8,000 units it's 150,000.
Because there was a closing inventory of 2,000 units.
Yes. So we are not selling it.
Yes.
We have to take the cost out for what we are not selling it.
Right.
So the difference between these two will be taking it to next year.
Okay.
Yes. So moving forward, what we did yesterday and clearly showing that as well. We said when we look at marginal costing, and in marginal costing we just concentrate on the variable cost, and we said the 3 variable costs that relates to manufacturing are direct material, direct labor, and the variable manufacturing overheads.
Yes.
And if we add them together, it gives us the product cost,
Yes.
which are related to the manufacturing of the product. But to understand that, we said this is the product cost for 10,000 units.
Yes.
That we have produced.
Yes.
But again, because we have just sold 8,000 units, we have to clearly calculate out of this how much is for 8,000 units,
Yes.
and how much is for 2,000 units.
Yes.
And for doing that, you divide this by 10,000.
Yes.
You multiply the answer with 8,000 and you get the price for 8,000.
Okay, so you take the 840,000, you times it by 8,000,
Yes.
which is the units that's been sold.
Yes.
And then you divide it by the 10,000.
Yes, because that is for total 10,000.
And then the number that is left, you take the total product cost
Yes.
times by the 2,000 units,
Which
and
is
then
the
divide
closing
it by
stock, yes.
the total amount, which is the 10,000 units, which gives you that cost. And now presumably, if you add both those two together, it gives you 840,000.
Absolutely, that makes sense. So this is what we have to take in our income statement as a cost of goods sold when we're moving forward, because we are just looking at the amount which we have sold, right?
Yes.
So if you come to the statement now, and this is the statement, it's clearly showing. It says we have sold 8,000 units.
Yes.
The selling price was 200 per unit.
Yes.
So that's our sales.
Yeah.
We have just calculated the variable cost of sales for 8,000 units.
Yes.
And this is what we have calculated.
Yes.
If we take this out, the sales minus variable cost, it gives you the contribution, the term
Yes.
we learned yesterday
Yes.
as a difference between the variable cost and the selling cost. Then we got selling overheads as well, the one we calculated because we have
Yes.
just sold 8,000 units.
Yes, and this would be on the administration charges, I presume. Or
Yes, they are the selling
Yes.
and admin.
Yes.
So that comes out, it gives you the final contribution. You take out your fixed overheads out
Yes.
to give you a net profit.
Yes.
Yesterday we did the same thing with a different method, and I'm
Yes.
going to do the same with a different method to make it more understandable.
Okay.
So if I
excellent.
quickly go through that on my board, it says sales, and if you look at sales, it's your this one. So that's your sales figure.
Yes.
If we take out cost of sales, which we are looking for only 8,000 units, because we have sold 8,000 units. So you sold 8,000, you look at the cost of 8,000.
Yes.
And if you go back to the previous slide, we have already calculated it, and we said it's 672,000.
Yes.
You take it out and you come to your contribution, and this is contribution.
Yes.
After contribution, we have to take out all the fixed and non-manufacturing.
Yes.
So you can do the way they have done it, or you can combine them as well. And you
Yes.
said, what I'm going to take out from here is anything which is non-manufacturing,
Yes.
so not related to manufacture,
Yes.
and which is fixed in nature as well.
Yes.
So these are the two costs we are looking into. So we're looking
Yes.
at fixed manufacturing because they are fixed.
Yes.
We're looking at fixed selling and admin because that is fixed, and we are also looking at variable selling because that's non-manufacturing.
Yes.
So we combined all these three,
Yes.
we take it out, and the remaining will be your net profit. So we'll be looking at 150,000 as variable selling. We're looking at 300,000
Yes.
as fixed manufacturing, and we are
250.
also looking at 250 as selling. And when we combine them all together, it's 3, 4, 5, and it's 600,000. We take it out, and it gives you a profit
220.
of,
So that, in essence, is your net profit.
yes, net profit. And that's what I said yesterday, that the difference between the marginal and absorption costing,
Yes.
that we don't have a gross profit here.
Yes.
In absorption we got gross profit, but
Yes.
in marginal we got a contribution.
Yes.
And we got a contribution here because this is only the
Yes.
variable element and not the fixed element.
So from my understanding, and
Yes.
correct me if I'm wrong, the difference between marginal and absorption costing
Yes.
in terms of the cost of goods sold
Yes.
will be that in the marginal costing there is only variable costs in the cost of goods sold, whereas in absorption costing there's there's fixed and variable costs
Absolutely.
in the cost of goods sold,
Absolutely.
which leads on to your gross profit, and in direct comparison to marginal costing, which is a contribution based.
Absolutely. And that's a very good level of way of explaining it, because now when you're going to make the same statement on absorption costing,
Yes.
you will realize that the answer is different for the profit.
Right.
And like we just said, that because the difference is between when we're looking at the fixed manufacturing overheads.
Yes.
So here we have taken it as a period cost,
Yes.
and all of them has gone out.
Yes.
But when we'll be looking at absorption costing, we will realize that we are just taking this for 8,000 units,
Yes.
not for 10,000 units, and the remaining 2,000 units makes the difference.
Yes.
So that's the same thing.
That's really good, and you've made it absolutely clear. So I presume we're going to see an example of absorption cost.
Absolutely, that's what we're going to look at. So when we look at absorption costing, we do the same thing what we did before we started the income statement and the marginal costing. We added the cost, which is as a product cost. The first three figures, so first direct material, direct labor, and variable manufacturing overheads are same.
Yes.
The final figure we add here is the fixed manufacturing overhead, which is a product cost under absorption costing.
Yes.
You total that up, And again, you divide this cost under 8,000 units and 2,000 units.
Yes.
Doing the same thing, we quote 912,000 here and 228,000 here.
Yes.
This is your closing stock.
Yes.
This is your cost of goods sold
Yes.
for 8,000, but it got the element of fixed manufacturing overhead.
Yes.
And that is the basic difference. So if we look at the statement now, we are looking at this. Again, sales figure is same.
Yes.
Cost of goods sold, we have just calculated with the 4 elements as
Yes.
product cost.
Yes.
You take 2 out, it gives you a gross profit.
Yes.
You take out your variable selling overheads for
Yes.
8,000, which we
Yes.
calculated as 150,
Yes.
and your fixed selling and admin overhead, which is 250.
Yes.
These both are non-manufacturing, and that's why it's after gross profit.
Yes.
And the final figure is your net profit.
So there's a higher figure in
Yes.
absorption costing
Absolutely.
in comparison to marginal costing.
Yes.
And why specifically is that?
That is where people has to reconcile the two statements to understand that there is a difference and why there is a difference. And for doing that, we use this, the reconciliation of two profits. So what we have done here is we said the profit under